All right, so let's get started. So welcome everybody to the LSE for this evening's event. My name is Dimitri Vagianos and I'm Professor of Finance at the LSE and Director of the Financial Markets Group. I'm very pleased to be here to welcome Poul Thomsen at the LSE, where he will deliver a public lecture on the European Capital Markets Union. After delivering his remarks, he will be in conversation with LSE Professor Charles Goodhart, who I'm also very pleased to welcome on stage. And then finally, there will be questions from the audience. So this event is organized by the LSE Financial Markets Group. Let me just give a few words of introduction for our two speakers and for the topic. So Poul Thomsen is the director of the IMF's European Department, supervising the fund's bilateral surveillance work for the 44 countries in the European Department, its policy dialogue with EU institutions, its program discussions with European countries with fund-supported programs. Before taking over as director of the IMF's European Department, Mr. Thomsen led the bailouts of Iceland, Greece, Portugal, and Ukraine, some or all of which involved major design challenges and very tricky issues to resolve. Charles Goodhart is Emeritus Professor of Banking and Finance within the FMG. He actually co-founded the FMG together with Mervyn King, and served as its deputy director between 1987 and 2005. So from 1985 until his retirement in 2002, he was the Norman Sosnow Professor of Banking and Finance at the LSE. And previously, he worked at the Bank of England for 17 years as a monetary advisor, becoming a chief advisor in 1980. And he was appointed as one of the outside independent members of the bank's new monetary policy committee until May 2000. So the title of today's talk is Capital Markets Union and European Integration. So this is a very important topic. Capital Markets Union is an important element of the economic architecture of Europe. So integrated capital markets have the benefit of improving the matching between savers and borrowers. This can increase productivity, raise GDP, makes economies more resilient as risk is shared more broadly. So Mr. Thomsen will weigh the macroeconomic benefits from a capital markets union, will identify obstacles in its path, and suggest targeted concrete policy actions. He also placed the CMU in the broader context of the European integration project. And the subsequent conversation with Professor Goodhart will expand on these issues. So, of course, we're in a Brexit world, and CMU is a project that concerns European integration. Actually, this makes it all the more important. CMU is very relevant for the UK, and also, of course, at the LSE, we're very interested in discussing European issues in general. So a few words of administration, logistics. So for Twitter users in the audience, the hashtag for today's event is hashtag LSECMU, and we encourage you to use this in your tweets tonight. So please put your phones on silent as to not disrupt the event. So this event is being recorded, and we plan to make it available as a podcast and as a video, subject to not having any technical problems. We also have a photographer here to capture the event, and a selection of photos will be made available on our website. If for any reason you don't want to be in the images that may be published, please let us know in advance. You can let you can let her know. And similarly, if you don't want to be in the recording, please choose a seat behind the camera, which is just in the back there. So there is no fire alarm testing scheduled for today, so if you hear the alarm or are instructed to leave the building, please do so immediately, as it will not be an exercise. And, and as usual, after the lecture, there will be a chance for you to put your questions to Poul Thomsen and Charles Goodhart, so please wait for the microphone to get to you before you start asking your question. Having said that, now please join me in welcoming Poul Thomsen.
Charles, Dimitri, thank you very much for inviting me to come here, and thanks to all of you for spending a Friday evening to listen to me. Much appreciated. So yes, I have been asked to share some thoughts on European Capital Market Union, CMU, including on its macroeconomic benefits and how it fits in to the broader context of European integration. This is actually, from our perspective, quite timely, as we just we're just about to publish a paper on capital markets union. This paper is a part of our contribution to the ongoing debate about how to adopt and change the EU's economic architecture, not least the Eurozone's economic architecture. Already back in 2013, when the discussion of architecture gained renewed impetus sort of in the wake of the Euro's existential crisis, we published a paper on banking union. A few years later, we published something on how to simplify the fiscal rules, and last year we published a paper on essential fiscal capacity for the Eurozone. So with a forthcoming paper on how to integrate European capital markets, we have a full set of papers covering all the main issues of the ongoing debate on European architecture. The paper is in advanced stage. Actually, we discussed it last week with our executive board, and then we're about to publish it in a few weeks, but I will share some of the main ideas with you tonight. So, CMU, on the face of it, it is a relatively uncontroversial idea. Certainly by comparison to proposals regarding, the proposal I mentioned regarding essential fiscal capacity and common deposit insurance. There is an understanding that capital markets integration could have important economic benefit without involving the concerns about public risk sharing, concerns about creating a transfer union through the back door that rightly or wrongly have proven a formidable obstacle to progress on both essential fiscal capacity and deposit insurance. To put the point differently up front, at a time when we appear to be well away from reaching a public consensus political consensus on public risk sharing, public cross-the-border risk sharing, it might be more realistic to get political support, to seek political support for measures aimed at a higher degree of private risk sharing, in particular by promoting cross-border capital market activities. In this regard, let me remind you that the risk to the euro area's stability arising from country-specific shocks, risks that were so violently at display during the euro area crisis, remain very serious. Lack of structural reforms mean that little progress has been made on closing the productivity gaps among member states, leaving some countries with low potential growth rates and high structural unemployment. And highly indebted countries have not, in the meantime, taken sufficient advantage of several years of relatively robust GDP growth to reduce debt. In some cases, fiscal policy during the last couple of years have actually been pro-cyclical. They are left, therefore, with even less fiscal space to counter shocks that are country-specific, with a correspondingly higher risk in the future that a shock would force them into a pro-cyclical tightening just when things starts going down. Thus, greater private cross-border risk-sharing through deeper integration of banking systems and capital markets could certainly help increase the euro area's stability in the face of country-specific shocks that cannot be addressed by a response from the common monetary policy, by definition, by treaty constraints. So, this is sort of the background. Here, the comparison is often made to the United States, with a much larger degree of private risk sharing across states means that a much smaller burden of adjustments to of shocks to individual states, much smaller burden of that adjustment falls on the individual states in the case of adverse shocks. In the euro area, listed equities amounts to some 68% of GDP. In the United States, the ratio is closer to 170% of GDP. In the euro area, private sector debt securities stand at the equivalent of about 85% of GDP. In the United States, the figure is above 100%. This means that less than 1/3 of non-financial firms' liabilities in the euro area are tradable instruments, compared to more than 2/3 in the United States. The flip side of this, of course, is banking system size. Total banking sector assets amount to about 300% of GDP in the euro area, dwarfing the US ratio of about 85%. In the EU, as much as 40% of household savings are held as bank deposits. In the United States, the share is only 1/10. In addition to being small, European financial markets are also sharply segmented along national lines, exhibiting a very strong home bias. Almost half of the equity holdings of EU insurance companies, for instance, are in firms registered in the home country of the insurer, rising to 60% in Spain, 70 to 75% in Germany, the Netherlands and Austria, and 80% in France. We see similar pattern in Europe's pension fund industry and indeed in banking. In other words, Europe is a long way from having a single financial market, and the implications are costly. What are the implications? It causes fragmentation. The fragmentation causes barriers to innovation and growth, to economic integration, and it hurts macroeconomic resilience by reducing cross-border risk sharing. We have tried, as part of this work on a capital market union, to quantify these costs. Let me talk a bit about this. First, the barriers to integration. European firms face sharply divergent financing costs based purely on national domicile. Controlling for firm-specific features such as size, profitability, leverage, and fixed assets endowment, our analysis for this paper suggests that the average Italian firm, for instance, pays 100 basis points more on debt than the average French firm. For Greek firms, the funding cost disadvantage to, say, Germany is 250 basis points on average. For smaller Greek companies, even much larger. Greek and Italian firms are not alone in facing an uphill struggle relative to their German and French counterparts. Second point about constraining innovation and growth potential. Firms with limited plant and machinery to offer as collateral, think of your typical IT startup, face immense difficulty assessing bank loans and are thus especially disadvantaged when the home capital market is small. Here again, in our quantitative analysis for this paper, we find clear evidence that such firms grow significantly faster in more developed capital markets, where venture capital funds with diversified portfolios are more willing to take the risk of providing financing without tangible collateral. Third, as to shock absorption, we estimate that this shock absorption across border, we estimate it to be 4 times stronger in the 50 US states and Canada than in the EU. Thus, we have run some calculation that suggests that for every 1% drop in a national GDP growth relative to the EU average, consumption drops by 80 basis points on average if the country is in the EU, whereas a similar calculation for the US suggests that the drop is only 18 basis points. This total breakdown, of this total, only an estimated 16 basis points of domestic growth shocks are smoothed through capital markets and credit channels in the EU, whereas it's about 72% in the United States to capital markets channels. Moreover, cross-border risk sharing through fiscal channels are almost non-existent in the EU. They are non-existent in the EU, whereas in the US it's about 10 basis points. So there is a significant scope for increasing the resilience of the macroeconomic resilience, particularly of the euro area, where there's no individual monetary policy response possible through promoting these cross-border flows. More generally, greater financial integration in Europe offers powerful prospects, macroeconomic prospects, both on terms of growth and resilience to cyclical swings. Before getting to our concrete proposals for how to promote CMU, I want to sort of motivate our choices a bit by, if you allow me, to spend a few minutes on being a bit abstract about the basic differences between bank-based and capital market-based finance. Remember that the core funding base of banks is risk-averse depositors, while that of capital markets is yield-seeking investors. Through a long and bitter experience with financial panics, we have developed a system where one fundamental difference between banking and capital markets is a special privilege that banks enjoy under the public financial safety nets. This safety net has multiple strands. Banks enjoy the right to retail deposit insurance backstopped by the state but funded by the industry. In addition, they enjoy the right to liquidity from the central bank against eligible collateral and the right to place liquidity at the central bank, the safest counterpart in the land. All of this makes banks safer, but can also create moral hazard, meaning an incentive to take risk when one knows one is protected from some or all of the downside risk. And there's more. When banks fail, and they do fail, the government's promise to stand behind them creates a natural role for the government in their wind-up. This is why we have state-directed bank resolution as distinct from private corporate insolvency. And both to offset the moral hazard effects and to contain the financial stability risks from the mixing of leverage and maturity transformation, banks are prudentially regulated and supervised with the explicit mandate of reducing the probability of failure. Contrast this with a relatively pure form of capital market intermediary, the mutual fund, where banks focus on taking deposits with a promise to return them on demand and at face value. Mutual funds take equity with the prospect of higher returns, but also a disclaimer on potential losses. In the mutual fund industry, savers are exposed directly to end users of their funds with no public backstop. Official oversight is focused on ensuring transparency and good conduct by the fund managers, with no mandate to limit losses. And the oversight is often of an exposed nature, contrary to the more ex-ante prudential oversight in banking. Risk-taking is here to a very large extent modulated primarily by market forces. One more point. Banks lend based on relationship and proprietary information. Remember that. Given the relatively level playing field among banks, they all benefit from the same safety net. Information gathering forms the essence of competition in banking. You collect as much data as you can on your borrowers. You nurture your customer relations in the pursuit of repeat business, and you never share your data with others. And information gathering, of course, costs money. When we borrow from banks, we pay for a broad range of overheads. Mutual funds, in contrast, invest at arm's length. Here, the name of the game is reliable, comparable, publicly available information. The fund buys a tradable security after its manager has skimmed the prospectus, a much less costly endeavor than gathering bespoke information, and he doesn't know much that other fund managers do not know as well. Here, success depends on wise investment choices, proper valuation practices, and portfolio diversification. For the recipients of mutual fund investment, the issue of debt and equity securities, the benefit lies in being able to access savings with less margin taken by the middleman and thus a lower cost of funds. Why am I mentioning these things? In view of these basic differences between banking and capital markets, it's not surprising that the plans for banking union have focused on creation of a centralized supervisor of systemically important banks, the SSM, on the creation of a centralized bank resolution framework, the SRM, backed by a central fund soon to be backstopped by European Stability Mechanism, and on creation of a common European deposit insurance scheme. In contrast, the general principles that I have just sketched suggest that the primary focus of efforts to create a central a CMU should be more on ensuring greater transparency, reducing variability in investor protection regulation, and on improving insolvency regimes. The overarching theme here is much more on allowing market forces to work better and much less on reducing the likelihood of failure through intrusive prudential supervision. This emphasis on transparency, regulatory consistency, and the insolvency framework suggested by these somewhat theoretical considerations that I just outlined are very much in line with what we found from a survey of national market regulators and large institutional investors that we did when preparing our forthcoming proposals on a CMU. The survey results point to three main issues. First, insufficient transparency, including an access to data on listed and unlisted companies, and in withholding and uncertainty about withholding of taxes. Second, deficiencies in national insolvency frameworks. And third, variability in regulatory quality across countries. These factors from the survey that we did emerged as key obstacles to integration. I'll touch a bit on Brexit later, but let me just note that the most respondents in our survey identified United Kingdom as clearly the EU's most attractive capital market jurisdiction. With that, let me now turn to our concrete proposals for how to advance capital market union. I should note that our proposals are broadly consistent with the European Commission's action plan, which we generally support, but that we focused on key initiatives that we think have greater chance of gaining political support in the current environment. First, let me focus on transparency. Here, the European Commission has done good work. Its prospectus directive mandates a single EU template for prospectuses of large issuers with a harmonized approval process. The result is a standardized, simple to produce, easy to approve, and understandable disclosure vehicle, bestowing a passport for distribution in all EU member states. The recent prospectus regulation tasked the European Securities and Markets Authority, ESMA, with storing all such prospectus and making them available via a free and searchable online database. This is an important progress. We propose this work be taken one step further. with a major additional step of instituting centralized, standardized, and compulsory electronic reporting for all issuers, not only large issuers, on an ongoing basis. This would be a major change to the reporting framework in Europe. But we note that similar steps are already very much established elsewhere. This is very much in line with what's happening, for instance, in the United States. So this recommendation to bring the European reporting framework on par with the US and is a key part of our proposal for what to do next. And as such, I guess some of you might be overwhelmed. For a key measure, you might find our proposal to be timid. I would disagree. What we are proposing would give investors ready access to company data in a central location in a standardized format, whereas at present reporting is fragmented along national lines and not standardized. In our view, mindful again that market-based finance resolves around publicly available information, as I just outlined, the direct impact of our proposal on price formation and market efficiency should not be underestimated. We think that it could be a relatively powerful tool going forward. Another element I should mention, another important proposal to enhance transparency would be to streamline procedures for cross-border refunds of withholding taxes on dividend and interest income. We hear from our survey that that is a major issue, an important issue. Here one could harness technology to create a single electronic portal to simplify tax reclaims. Second, what about the quality of insolvency practices, which was another important area identified by our survey? This is probably the most difficult area of all, because it's deeply steeped in national legal tradition. We are here at one of the core issues that define individual countries. One of the issues where diversity of tradition is a key part of Europe's political diversity. Here, harmonization will take place extremely gradually at best. Mindful of this, our recommendation on insolvency are admittedly relatively modest. Basically, we suggest an ongoing role for the European Commission along 3 dimensions. First, to carefully collect data in an area where the existing data is unreliable. Second, to develop a code of good standards for core features of corporate insolvency and debt enforcement processes. And third, to systematically follow up on member states' progress towards observing such standards. In essence, what we are proposing is an approach modeled very much on the Basel core principle process, with aims at nudging independent jurisdictions towards higher and more uniform standards in banking supervision. It's much the same that we are proposing here for the insolvency framework. Third and last, I turn to regulatory oversight. Recall that the emphasis of public involvement here should be on conduct of business oversight to protect investors, ex-post enforcement to deter misconduct, and insolvency practices to facilitate smooth market access. It is not about intrusive ex-ante regulations to minimize risk of failure, like in banking. Here, I would like to emphasize the importance of proportionality, of recognizing that there is a no one-size-fits-all solution in a space as heterogeneous as capital markets. It's neither possible nor desirable to prudentially oversee all non-bank financial intermediaries. Many capital market entities are wholly equity funded and do not engage in maturity transformation, and these are best left to the restraining hand of market discipline. Generally, prudential oversight is best kept light, including to discourage perceptions of a potential government backstop. Staff at the US Federal Reserve used to call this the halo effect, the risk that the public authorities might create bailout expectations and moral hazard simply by being seen to be talking to certain non-bank financial actors. This being said, there are a few market entities that are so systemic that their failure would pose systemic risks and where therefore strict prudential oversight is vital. I here refer to central clearing counterparties, in particular CCPs, but also to large and complex investment firms. CCPs are critical. Their enhanced role in derivative and repo market clearing since the global financial crisis increases safety and efficiency, yet concentrates tail risk in a few key nodes. Prudential oversight of CCPs focused on their margining practices, default funds, and capital must be deeply intrusive, seeking to reduce the probability of failure to zero. Finally, before concluding, and standing here in the long shadow of Brexit, I am acutely aware that my remarks today would not be complete without touching on the critical role of the United Kingdom in the European capital markets. Since 2016, CMU, Capital Markets Union, has faced a new reason for urgency with a Brexit vote. I don't need to dwell into much detail for this audience. London is a global trading hub for derivatives, spot foreign exchange, money markets, as well as gold, silver, and base metal. It's also a world leader in international debt issuance, international insurance, and international syndicated credit. It has given Europe important capital market links to the rest of the world, including a transatlantic dollar funding pipeline that helps finance large European holdings of US securities. In short, London exemplifies perfectly agglomeration effects in finance. If one were to reduce this reality to a diagram, one could easily characterize the European capital markets thus far as a hub and spoke system, with London as the hub. The spokes include many important network linkages, ranging from securities and derivative clearing in London to the widespread delegation of day-to-day investment decisions by the remainder EU mutual funds to London-based fund managers. Brexit thus poses a major challenge for the European capital markets. On the current course, hub and spokes looks like to give way to a sort of multi-hub CMU inside the EU 27, with some activities concentrated in Frankfurt, others in Paris, and yet others in Dublin or Luxembourg. There is clearly a risk that such fragmentation could reduce market liquidity and increase transaction costs across various market segments. Several network linkages could be disrupted. Significant international business would be carved out of the EU. So some global links could also be disrupted. In addition, the prospect of Brexit necessitates urgent upgrades to the EU 27 capital market oversight capacities and infrastructure to cope with a large-scale migration of activity out of London. This is already evident in some areas. In this regard, there is a concern doing the rounds that as the country with the deepest financial markets and financial market expertise exits the EU, a certain heavy-handedness could take root. You will understand from what I just said that I think it's very important that one bear this concern in mind. Despite my general advocacy for strong financial oversight, there remains a role for a light touch in some areas. Again, market regulation must be fit for purpose and proportionate to the risk. Thus, there are many ways in which Brexit is a huge issue for the CMU. But I do think the thing about, at this stage where the EU have to set up its own system for regulation, it's clearly important to bear in mind these concerns about that it needs to be proportionate to the risk. Last point. Reflecting the IMF's mandate as a guardian of the international monetary system, I want to stress the importance of international supervisory cooperation. We would argue that engagement among regulators is essential to maintain ties with important third countries on capital market issues. This is especially the case vis-à-vis the United Kingdom, given its tight financial links to the EU 27. As a general principle, diversification outside the EU should be encouraged, given the increasingly global nature of capital market finance. Okay, it's time for me to conclude. What I have sketched here today is a proposal for CMU that focus on a number of obstacles that, once overcome, could spur a significant deepening of European capital markets by stimulating market forces. It's a pragmatic and moderate proposal in the sense that it focuses on fairly technical issues, in effect accepting that a number of more fundamental and politically sensitive obstacles that can only be overcome in the long run. It reflects the view that focusing upfront on much more controversial issues, like a significant integration of insolvency regimes, could risk what we think are already could risk that we do not secure what could be significant gains from focus on sort of more technical low-hanging fruits in the long run. If you will, our proposal is a medium-term action plan for a currency union that is not a political union and still far from being one. It is not a plan for how to soon get to a US-style European CMU. This lies far, far out in the future. Circling back to where I started, looking at the CMU in a broader context, in the broader context of changes of Eurozone architecture, the CMU, together with banking union, will not give Europe anywhere close to the risk sharing that we see in the US in the foreseeable future. But it will be a very important step in that direction. So I'm going to stop here and happy to take questions.
Thank you very much, Phil. First of all, let's have some questions and answers with Professor Goodhart.
Paul, you were kind enough to send me a copy of what you were going to say a couple of days ago. And when I read it, I felt that your proposals were splendid, but not wildly ambitious. And after all, who can possibly object to having more data in a more standardized way? Who can object to having a harmonized approach to insolvency regimes in different countries? Who can object to better supervision? And yet, when one discusses these things in groups of experts, one finds that even these proposals, which I could almost describe as motherhood and apple pie, actually run into complications within the European context. The accounting systems in different countries are different. So the numbers that are supposedly the same are actually not going to be the same. Even if you harmonized the insolvency rules, the way that they would be interpreted and the way that they would be operated in different judicial systems would tend to be very different from each other. So given the sort of concern among experts, it is all extraordinarily difficult. And the fact that the proposals that you're putting forward are not really terribly ambitious. Am I right in concluding that actually CMU is light years ahead? It won't come in my lifetime, probably not in the lifetime of many of you here, that it's sort of baying for the moon. I mean, this is, isn't this really just peanuts?
So I think if by CMU you mean, as I said, getting to United States, yes, I think, Charles, it's not going to be in your or my lifetime. That's for sure, and I would actually probably say not in the lifetime of most people, even the young people in the audience. This will take a very, very long time. I mean, the fundamental obstacles like the need to, the need like in the US, you have a very powerful central regulator and having a uniform, much more uniform solvency regime. It goes to the heart of what it means to be a politically independent country, and we have seen from this difficult discussion on EMU architecture that there is not much willingness at this stage to sort of surrender sovereignty. So I can, from that perspective, I fully understand your remark. But we need to start somewhere, and I even if take an example, as you say, accounting. Yeah, it might be that the accounting standards are not they are not the same. So still, with the information that is centralized and accessible, there is still that problem. I agree, but we need to start somewhere, and I think this is a good start. I think on the insolvency, bankruptcy procedures, I think it is important to have a discussion of what is the gold standard. We have these in the IMF. We have these financial sector assessment missions that go out every 5 years and have a comprehensive assessment of the financial sector in our member countries. And throughout we find that authorities engage in very serious discussion with us on how to improve their standards, and are very, very keen to how we in our report can present them as having sort of moved up. So I do think that it's not totally it's not to sort of be completely dismissed, but fundamentally, I am part of policy making, and it's what's feasible, and this is what this is about.
Well, you say we need to start somewhere, but a lot of people would argue that you can't have a unified capital market so long as you have a fragmented bond market, and that neither banking union nor capital union will actually go very far as long as the doom loop and the problems of the sovereign bond markets as they are at the moment, disparate within Europe, continue. And there are, as everyone knows, many of these suggestions for a safe Eurobond and all the rest of it. And wouldn't that be possibly a more productive starting point?
So I, on the issue of a safe asset, I don't think that it is critically important. It ought to start getting closer to CMU. I think there are a lot of good reasons why Europe would want a safe assets, but I don't think it's critical to making sort of early progress on capital markets union. As far as the concrete proposals, clearly the proposals that assume some form for mutualization, there's just no appetite for that. That's not, that would be a purely academic discussion. There are other proposals out there that basically assumes that you bundle sovereign debt and cut them into various tranches. These are that raises some regulatory issues. What should be the risk weights? Right now, sovereign bonds have no risk weights in Europe, but in this case, if you did that, clearly the junior tranche would have to have some risk weights. This could possibly resolve. It's a discussion one should have. It's not clear to me that there would be a lot of support in member states, in some member states. I mean, we have had this discussion when we discussed deposit insurance, also common deposit insurance, where clearly some countries have said, for us to have risk sharing to deposit insurance, we need to have risk reduction. And risk reductions entails a number of things, but the things that are particularly sensitive is that some countries say that if we need to be part of a risk sharing via a deposit insurance, there needs to be a limit on banks' holdings of sovereign, and they are of course particularly concerned about weak countries, that if banks hold their local sovereigns, that could pose banks to risk that would become a demand on this common deposit insurance. And there's a lot of resistance to that. And I know banks that countries that have difficulties getting a handle on their fiscal problem and have big financing need are quite reluctant, very reluctant to agree to that. And other countries are also against it, even if they don't have sort of high debt and high refinancing need. And I guess many of the problems that we see there would also arise in the discussion of attributing risk weights to the lower tranche. So again, I don't think that safe assets are critically important for capital markets union. And as far as some of the proposal, I think there's still quite a lot of questions out there.
When CMU was initially proposed, it was actually, as I recall, pretty much a British initiative. And it was meant to be a component of a wider European framework in which the British could play a leading role. Not unincidentally, it would probably have benefited London if we'd had a CMU and the UK, as it still might be, was part of the euro area. And what we're going to get, as you said, was a multi-hub system without any centre. Now, do you think that will work reasonably well? Or once London leaves, if we do, aren't we actually going backwards? Or isn't Europe, the rest of Europe, going to go backwards in this respect?
Well, I would, first of all, the capital market initiative started well before the Brexit referendum, and it was not a response to Brexit.
It was when we thought that we were going to stay.
Right.
And it was the UK commissioner who was.
But the rest of us, the rest of would still argue for an integrated capital market for the reasons that I mentioned, seeking to reduce the dispersion of firms' funding costs across countries and to increase the cross-border resiliency. These are, with or without Britain in, critical for EU and particularly for the Eurozone's stability. So many of the issues are raised, as I said, are becoming even more acutely important with Brexit. Europe needs to think about regulatory issues. I don't see Brexit reducing the urgency. On the contrary.
Can I turn to an issue which is dear to my own heart because I worked for a time at Morgan Stanley, which is that I don't think that capital markets can work without supporting institutions, of which investment banks are very important. They do a lot of, for example, of book building for IPOs. They are market makers. In some respects, they actually act as smooth markets in many ways. And yet, when I look at the investment banking world, the European investment banks, such as they are all in retreat, severe retreat. And you look at Deutsche, you look at UBS, you look at Barclays, and whenever you get a meeting of the AGMs, there's always somebody saying, get out of the business. So are we going to have a European capital market union entirely serviced by American investment banks? And is there a problem with that?
Well, you know, I would certainly agree that one cannot have capital markets without investment banks. That's no, I agree with that, on that, and I would say both investment banks and commercial banks actually think about how a mutual fund needs a depository service of a commercial bank to store the liquidity it must maintain to manage redemption risk. Or think of how a hedge fund needs the prime brokerage services of an investment bank to execute its trades, to extend its leverage, or to lend securities for trade. So I'm with you on the importance. I mean, investment banks also have a strong role to play in helping firms raise funds in the primary market, in supporting mergers and acquisitions, and in ensuring that securities dealing can take place in the context of deep market liquidity. So I agree with you, and I also understand, of course, there is a number of big European investment banks are reconsidering their business models, and so I don't have an answer on this. I am if in the end it requires more service of foreign investment banks, I don't see any major problems with that. But
Well, let's assume that there's a certain American president who decides to take a dislike to Europe and tells the American investment banks to go ahead. It's not impossible.
Well, it's becoming very speculative now. It's I'm sure that Europe will maintain enough diversity to be able to respond. But if you say that such abrupt changes and capital controls and don't have disruptive effects, of course they have disruptive effects in the short run. But it's from where I am sitting, this is quite speculative.
Indeed. Let's not speculate too much about it. The sort of final point that I'd like to make is that I would have a certain hesitation about being so keen on light touch regulation. Light touch regulation for banks before 2007 seemed rather a good idea. Surely they're capable of looking after themselves and not making stupid decisions. And we are sort of at the moment in the UK, we're responding to the concern about the Woodford Fund and Hargreave Lansdown, and the problem of what happens when you have many mutual funds who have effectively instantaneous redemption, but where the fund holds assets which are somewhat illiquid and take time to resolve. And I think there's also the problem that, again, we're told all the time that corporates are taking a lot of highly leveraged, high-yield risky bonds, and that if interest rates should go up, there could be a problem. And if at that time you get a lot of bond funds with people rushing for the door, it would make everything a lot worse. I worry that when you're asking for light touch regulation on mutual funds, you are potentially landing yourself in the same kind of problem that the next recession could actually be generated by people rushing out of these mutual funds and throwing these bonds onto the bonfire. And it could be that this is just the moment when, rather than light touch regulation, we ought to have a concern about more severe regulation about the liquidity position, particularly of these mutual funds. Could it be that now is exactly the wrong moment to ask for light touch regulation of mutual funds?
So I most certainly did not, as a general principle, ask for light touch. That's a misunderstanding. I think you mentioned banking. Anything but light touch in banking. I said it was part of capital markets. I made very clear that CCPs and great systemically important investment funds, clearly there is also in capital markets a very strong case for anything but light touch. So I certainly agree that retail investors must be protected and funds must be held to the commitments they make in their advertising and their prospectus. Rules, coming back to what you said, rules capping the share of illiquid investments in fund portfolios must be policed and rigorously enforced, as must other investor protection requirements. I am not in any way, I certainly have misspoken if you get away with the feeling that I generally ask for light touch. On the contrary, what I say is capital markets are extremely heterogeneous, and one cannot sort of have the same kind of very intrusive, often ex-ante supervision that you have in the banking sector. I mean, it is. I'm not saying anything here that is new. It is already a general practice to a vast extent to rely on market forces. Of course, criminal behavior has to be prosecuted, but I am. I'm saying there are, particularly when we talk about entities that are not highly leveraged and that are based on equity, then investors who are seeking risks, generally, there's a limit to the extent to which you can protect or need to protect and regulate all of them. But I do not walk away here with the impression that we generally ask for light touch. We are in a situation where, because of Brexit, that on the continent they might have to rethink a lot of these regulations, and it's just a reminder that when you face these issues, you do not need to very heavy-handed regulate everything. That's all I'm saying. It is. Please do not conclude that the IMF calls for light touch on regulations. We do not. But we are. I say, you guys are want to leave, and you are leaving the rest of the continent to suddenly have to rethink its framework. And it's an important reminder when that happens. What are the basic principles, the basic differences between regulating and supervising banks and capital markets, particular parts of capital markets that are not leveraged and that are based on equity? I'm just repeating general principles that are already in play.
Perfect. Okay. Many thanks, Charles. And Poul, so let's turn it over to a general discussion. So what I want to ask you is that when you want to ask a question, so raise your hand. There will be a microphone that's going to come to you. And before asking your question, please keep it short, the question. Just let us know your name and affiliation. So this is important for the recording capture. So any question? Okay, so 1, 2, 3. So let's start with those 3, and then we'll answer, and then there will be...
Hello, good afternoon. It's a wonderful pleasure to be here. My name is Konstantinos Kanelopoulos. I'm a Jean Monnet Fellow at the University of Manchester, and I'm completing my PhD in political economy. I have a question with regards to the famous quote, "The time to build the roof is when the sun is shining." To what extent do you think that the EU has done enough to solidify the Eurozone now that the sun has been shining, and to be adequately prepared for the next financial crisis that's coming? And about the EU's ambitions, the Commission recently explained that the euro will become a competitor or a rival to the dollar potentially as a global reserve currency. What are your reflections on that matter? Do you think that's possible? Thank you.
Thank you very much. I think there was someone in the back. Who was? Yeah, someone there had raised their hand. No. Yes, and then the lady in the back. Yes.
Hello, I'm Morten Kinander. I'm a professor of securities law in Oslo in Norway. My question is twofold but connected, I hope at least. The EU Parliament and Council recently rejected the even modest initiatives from the European Commission in advancing supervisional powers of the Capital Markets Union. The only thing that was modestly ambitious that was left standing was the anti-money laundering initiatives. All the capital markets initiatives were rejected. So that doesn't bode well for the further integration of these powers that the Commission asked for. The other thing is that, that aside, if we were to be ambitious with the one single area, we can take the equity markets. And what do we think about a single listing authority, a single delisting authority, and a single market abuse authority regulating all cross-border and within-border authority and supervising? In today's technological world, it should not be a problem. And that does not involve the accounting problems, that does not involve the insolvency problems, etc., etc. Thank you.
Thanks. And in the back, the lady in the back.
Good evening, and thank you very much. My name is Lydia Cioli. I'm a PhD candidate in corporate debt restructuring and insolvency at King's College London. I would like to focus my question on the insolvency remarks that you made. In your initial speech, if I recall correctly, you mentioned only soft law measures regarding insolvency and restructuring. The insolvency and restructuring area, you mentioned the code of good standards, for example, and the institutions following up on members' actions on these good standards. Nevertheless, in the discussion later on, I think you referred to what we could call hardcore legislative initiatives, actual harmonization. And at the very beginning, you said we generally endorse the European Commission's action plan. So the concrete question is that actually on the 6th of June, like some days earlier, we had the first ever hardcore legislative directive actually voted, adopted by the European institutions on minimum harmonization of corporate debt restructuring frameworks across the EU. What is whether in your paper and generally IMF endorses that, because it's considered as a very first step of hardcore harmonization, as opposed to your soft law remarks later on, and what is your general view basically on hardcore legislative initiatives?
Yeah, let's start with the question you mentioned one needs to repair the roof when the sun is shining. And I do think that the sun has been shining. I would say that here I would say that member states, not the I'm not talking about the Commission and at the Brussels level here. I think member states have definitely not taken sufficient advantage, not all member states, of the good times to sort of become more resilient. I think in particular a number of highly indebted countries have done hardly anything through 3 or 4 years of strong growth to bring down debt. Actually, a couple of them have, even during the good years, relaxed fiscal policy. And therefore, they have less fiscal space in the future. And that is a problem inside a currency union where monetary policy is directed towards general shocks and where you only have fiscal policy to deal with country-specific shocks or the part of general shocks that affect you particularly badly. So I think from that perspective, I think it's disappointing that that not enough advantage have been taken of the good times, of the sunshine, as you put it, to build fiscal space. I frankly think a bit of the same problem, and that's more generally, is with the structural reforms. I think the support for structural reforms have waned as we got further and further away from the crisis. I think the Commission's indicators on structural compliance with their recommendation on structural reform suggest that that is the case. I will say one area now where we are talking about banking and financial market. I do think that clearly European banks are in a better position than they were before. So this is one area where I do think that one has taken advantage of the sun shining. Banks are better capitalized. NPLs are starting to come down significantly, or have come down significantly. So I do think that banks are generally in a much better position to weather shocks. At the EU level, I think EU has certainly now a mechanism to deal with crisis that it did not have back in May of 2010 when the Greek crisis erupted. But as we know, it's the architecture, central fiscal capacities, deposit insurance, these risk-sharing elements that could reduce the cost of being part of a currency union. They are not in place. So generally I do think that in terms of increasing the Eurozone's resilience to shocks, one could have made much better use of what is the favorable environment in the last few years. But again, the Eurozone has certainly the capacity to deal with crisis, if that's what we were talking about. On the other issues, on the European Parliament not being very supportive of proposals by the Commission, and it's essentially the same issue with solvency. We are fully supportive of the European Union's action plan for capital market union. We are including on some of the longer term ones, but we are in line with what I just said on the disappointing progress on architecture the last few years. We just don't see much political willingness to move in these areas. So the fact that we are making these proposals, which are, as Charles said, a bit perhaps not super ambitious, but it is again, policy making is about pushing forward what is feasible, and that's the world I am in. Does not mean that we do not support You know, we do not support harmonizing regulatory framework, harmonizing solvency regime. You mentioned a single authority on equities, but it is not going to happen anytime soon. And this is not. If policy making is about pushing forward what is feasible, this is not what we are focusing on. But we are certainly in our reports supporting these longer-term objectives very strongly.
And the question about your view on the EU directive on insolvency, this lady in the back.
Yeah, but it's a bit the same, right? It's a bit the same that we are. I think the only thing that is really realistic is environment. What we are proposing to sort of, shame countries into trying to raise the bar.
Okay, 1, 2. Okay, 3. Okay, 1, 2, 3 for now, and then.
Yeah.
Yeah. Here to this gentleman.
Paul McGrail, Peace News. A question for Professor Goodhart. There's been a lot of talk recently about the yield curve inversion and whether or not it's important for recessions. If you could comment on that. Also, the amount of debt, the aggregate debt, nowadays compared to traditional conventional debt, which was via the banks. And apparently now, with the corporate bonds and private equity and all that, is there any way of knowing what debt is as a generic term? And lastly, if you could say a word about debt to GDP ratio, and is there an inflection point which can be a nominal benchmark for all sovereign debt?
Thank you. I'm a professor at the RIC.
Just your name. Sorry.
Yeah.
Your name and affiliation.
Yeah. My question will involve roughly connected with your part of your answers. It is like that. How do you find the capital market integration policy, and what is the relation between the capital market integration and the physical policies? I think that you understand that the European sovereign crisis decades ago, one of the main reasons is the imbalance between the physical policy and the monetary policies. While the European Central Bank follow kind of unit monetary policies, different countries, different governments carry out a kind of different physical policies facing the different problems. But while decades passed, but the roughly situations remained there. You now offer us a kind of CMU strategies. If that problem didn't solve, can your ideas, strategies will lead another kind of crisis, may called capital market crisis? Thank you.
I'll try to stand. I am Panayotis Varkas I'm a competition economist at the OECD, Director of Financial Enterprise Affairs. Thank you, first of all, for your speech. Very interesting, Mr. Poul Thomsen, and thank you, professors. My question is concerning the political versus financial aspect of what you mentioned. Do you think we have to wait for a closer political integration in the EU before going into into deep debates, maybe about further financial and regulatory, in this case, capital market union? I'm saying this because if we wait for further political union, I feel that in Europe at the moment, the local or national politics are much more affecting the business decision, the investment decisions, if you want, compared to the EU maybe, as they are changing much faster compared to the EU, etc. And if this applies, I would say that national policies would play, at the moment, at least in the short term, for business decision, Keynes would say, a much more important role. This means that the assets diversification then would not be stable over time, and if you want also the more modern portfolio theory in that case would not apply, as the correlation would not be stable if political local circumstances are changing much more faster. With these two, if you could reflect on this, if I'm clear. Thank you very much.
Thank you. Okay, so you want to talk about debt to GDP or inversion?
Okay. An inversion of the yield curve has been a pretty good predictor of recessions, both in the US and in the UK. Personal advert. If you look up the CEPR working papers, you will see a paper that I published on that about 2 months ago. There are some problems with it a little bit at the moment because the yield curve may have been affected by QE, which might make it a slightly less reliable indicator than it has been in the past. All an inversion of the yield curve actually means is that people are expecting short-term interest rates to come down in future, which you do when you think a recession is going to come. And if the market is generally right in its forecasts, it obviously must be a good predictor. And yes, one of the problems with having to deal with the sluggish recovery from the economy has been that interest rates have been kept terribly low, which has encouraged a huge accumulation of debt in private sector corporates, and in some countries in the housing market, and in a number of countries also in government debt. And quite how we will get out of this particular problem if and when interest rates should have to rise in future is a very difficult question. And I'm glad to say I don't have to answer that now.
Yeah, so I perhaps just picking up on the issue of debt to GDP that you asked. I assume that you're asking, because there is a debate right now about that with a lower natural rate of natural interest rate, perhaps countries can have bigger debt burden. I guess that's where you're coming from, and I think that's a very legitimate discussion. It's a very complex issue. I'm not going to get into that discussion here. I'll just tell you, as you know, again, as somebody who part of policy making, and who see that governments are not using the sunshine to repair the roof, who knows that fiscal policy, a number of countries are inherently pro-cyclical. You know, the fact that the abyss might be a bit further away, the fact that we have been for many years, number of high debt countries have been moving towards it. It's yes, it's certainly good that they can have higher debt, but if you see that there are structural problems in fiscal policy that sort of that means that debt keeps on increasing, it is only a limited comfort that we need to deal with the underlying problem, which in a number of European countries are really the need for reforms to boost growth and having higher productivity growth in a number of countries. I think that is to me the real answer. If I understood you right on the, and correct me if I'm wrong, but you ask whether the proposal to sort of spur capital market integration just sets us up for another crisis. It's a very legitimate question. I have spent a lifetime dealing with sort of crisis from sudden stop of capital inflow. So it's a very legitimate question. What we know is that bank lending is inherently more volatile, is more cyclical, and that capital market financing, particularly equity financing, is much more stable. In the case of crisis, equity financing does not tend to run for the exit at the first sign of crisis. There's clearly there is a discussion to be had. I'm not saying that the U.S. model of having much more reliance on capital markets and much less on banking is where we need to get at. What I say is that European capital markets are really very underdeveloped, and there is a long way before we really need to be concerned about capital market dominance. And all the problems, including the one that you raised. So I would not be too concerned about this given where we are now. I am not sure I fully understood the question about whether we should wait for political union to get full capital market union. I think I think we can. Full political union is far out in the future, and I think in the meantime, one can get close to something that's much closer to where the United States is right now. I think one should. The Commission is right in pushing these issues, even the ones where there's no political support now. One need to keep them on the agenda. As I said, we are fully supportive of that. We are proposing some sort of relatively small step that's possible in the current political environment. But I don't think one in the end need to have full political union in order to surrender sovereignty, regulatory sovereignty to ESMA. But it's not happening right now. There's not political support for this right now.
Couple of maybe last questions. Yeah. Okay. One question, and then there's another one here. Yeah, please here to this gentleman here. Here.
Right. I'm Saki Bijio. I'm a professor at UCLA. And perhaps I'm going to say something that is controversial. I think differently from Charles. I think the proposals were could be simpler. So this is what I have in mind. We know from a basic economic principle that it doesn't matter, as long as markets are competitive, who has access to investment opportunities and who has access to the fund to those opportunities. If markets are competitive, then markets will allocate resources efficiently. And you can extrapolate that argument into a chain where you have an investment opportunity here, and then through a connection across firms, if resources come from another sector, then the economy will find its way to where the investments are. So what do I have in mind? I have in mind that a simple proposal for Europe is to try to have policies that consolidate the banking industry into big mega banks in Europe, a number like 30 or so, that could channel resources across countries. It's something simpler than a banking union because it would consolidate the equity and the funds internally. And it would be easier to regulate because the number is smaller. And if you have to bail out, it's easier to reach an agreement within Europe if these are cross-border institutions. So, I want to put forth the idea that we want to have mega banks in Europe with positions in multiple countries.
One more question by this gentleman. Yeah. And then I think we will have to run out of time.
Stuart Fleming, St Antony's College, Oxford. Isn't it fair to say that the US Treasury market is a safe asset which is absolutely critical to the functioning of the US financial markets, both in terms of liquidity, trading, crisis management, crisis prevention, and also in terms of the international role of the US dollar. And therefore, I'm surprised that you're saying that it's not the safe asset issue is not critical to the euro area, particularly at this moment in time when we're looking at the US using the dollar in a coercive way, quite deliberately as a policy dimension, and when the same challenge is being, China is trying to pursue the same sorts of policy, although with less success.
Here I need to, it's good that perhaps I was not clear enough. I did not in any way say that a safe asset is not important in the long run, and in particular for the development as the euro and as a reserve currency. I fully accept that. It's but I was talking about harvesting the sort of early gains, unlocking early gains from the capital market union. I'm talking about a number of, yes, fairly, timid or not timid, but technical changes that I have proposed here that will generate a higher degree of risk sharing and therefore help reduce, increase the resilience of the Eurozone in the short to medium term. I was not talking about what's needed in the long run to get to a full capital market union and a euro that is an international reserve currency. This is not what I'm talking to you about. I'm sitting here to talk to you about what if we decide to meet in 3 or 4 years, what can we in the meantime do to sort of try to advance this in practice. This is my world.
You want to comment anything on mega banks?
No, I am not going to comment. I'm enough of a bureaucrat not to respond to something on the spur of the moment.
If there are 27 countries in the EU and 4 or 5 mega banks, which countries are not going to have a mega bank headquartered in their own country? You can't ignore the politics of this. Everyone will want the mega banks in their own country and won't want to give up control over their own important banks. And again, it's just not politically feasible.
But then how do you get scale?
What?
How do you get scale?
How do you get what?
How do you get scale?
The banks are not making money, the ROEs are dismal. They have to merge at some point, but I agree with you, it's not going to happen. It's a catch-22. Even within the same...
Well, we're going over time. Yeah. But for example, in Germany, the main problem is that you've got hundreds of small cooperative banks and Landesbanks and all that. The structure of banking is a major question in Europe. But that comes under the heading of what to do with banking union rather than under the heading of what to do with capital market union, which provides an excellent chance for you to wrap up.
I'm happy to do so. So anyway, so let's say it has been a great pleasure to have the opportunity to have Poul Thomsen here to talk to us about Capital Markets Union and to also have Charles Goodhart to be in conversation with him. So thank you very much, Poul, for coming to